Okay, let's dive in. We're unpacking Instacart's Q3 2025 results and looking ahead, especially under new CEO Chris Rogers. First full quarter, right?
Exactly. And look, the strategy is clear right from the get-go. They're really pushing this idea of being a technology and enablement partner now, not just delivery.
Got it. So let's start with the numbers then, the Q3 scorecard, because it looks like a pretty solid beat overall.
It really was. The core business showed good momentum.
Orders, for instance, they grew 14% year over year. That's 83.4 million orders. Just be discreet account estimate there.
And crucially, gross transaction value, GTV,
Yeah.
that grew 10% year over year, came in at $9.17 billion, which beat the FactSet estimate.
Okay, 9.17 billion. And revenue followed suit.
Yeah, total revenue hit $939 million, also up 10% year over year, and also a beat.
So solid top line, but I think the profitability story is maybe even more interesting here. Adjusted EPS came in at 51 cents, right? Versus delay 9.49 as expected.
That's it, and that shows real operating leverage. GAAP Net Income was strong, $144 million, up 22% year over year.
22%, wow.
And adjusted EBITDA grew at the same clip, 22% year over year, reaching $278 million. So they're definitely getting more profitable per transaction.
Okay, but there was one wrinkle, wasn't there? Average order value, AOV, actually went down slightly, like 4% year over year.
That's right. It did decline 4%.
How does that work? Revenue beat, profits up, but basket sizes are shrinking? Seems a bit odd.
Well, it's actually a strategic move. It's a trade-off they're making quite deliberately.
Okay.
They want to boost engagement, get people ordering more often. Two things driving it. First, just general growth in smaller restaurant orders. Second, and this is key, they introduced that lower $10 basket minimum for Instacart Plus members to get free delivery.
Ah, right. So lowering the barrier makes it easier to place smaller, maybe more frequent orders.
Exactly. Sacrifice a bit on AOV to get higher order density and build that customer habit. Loyalty.
Makes sense from a long-term view.
Good.
So looking ahead, what's the forecast for Q4? Always a big quarter.
They seem confident, but also cautious. GTV guidance is between $9.45 billion and $9.6 billion. So that's about 9% to 11% year-over-year growth.
Okay, 9 to 11% growth. And profitability.
Adjusted EBITDA guidance looks solid, too. They're projecting $285 million to $295 million.
Are there any specific headwinds they called out, things keeping that growth maybe just under, say, 12%?
Yeah, a couple of things. They said the guidance reflects a strong October and good enterprise momentum, but there's some external risk. Specifically, they mentioned the expected impact of EBT, the Senate funding scenarios, government uncertainty there.
Right, EBT SNE, the Food Assistance Program.
Yeah.
So uncertainty around that funding directly impacts a segment of their customer spending in Q4.
Precisely. It creates a potential headwind on volume for those users. And beyond that, they also flagged that advertising revenue growth might slow a bit in Q4.
Oh. Ad revenue slowing. Retail media is usually so hot.
It is. They're forecasting 6% to 9% year-over-year growth for ads and other revenue. Management put it down to macro uncertainty, basically. Some big brand partners, the CPG giants, are maybe pulling back on spending a little.
Okay, but they expect that to bounce back.
Yeah, they sounded confident about getting back to double-digit growth there in 2026. But Q4 might see a bit of a squeeze from those big ad clients.
Okay, that makes sense. So let's pivot to the strategy. You mentioned Chris Rogers has these 3 focus areas for acceleration. Affordability is the first one, right?
Absolutely. And this feels fundamental. They see price as the biggest hurdle left for really broad online grocery adoption. So they're pushing hard for price parity.
Price parity meaning online prices match the in-store prices, no markups.
Exactly. And they have the data to back it up. They said retailers who adopt same as in-store pricing, they've grown, on average, more than 10 percentage points faster on Instacart than retailers who haven't.
10 points faster. Wow. That's a really strong incentive for retailers. Who's jumping on board?
We're seeing some significant names. Pattison Food Group up in Canada, their banners like Buy Low Foods, Save On Foods, also Best Buy, Choices Market, Jerry's, and they're running pilots in places like Chicago, Dallas, Nashville.
So Instacart is almost acting like a consultant here, showing retailers that lower prices can drive massive volume.
Kind of, yeah. It's about proving that sacrificing the markup can lead to much greater overall sales and customer loyalty in the long run. It's that volume game.
But wait, if they're pushing for lower prices and enabling smaller baskets, how are their own unit economics getting stronger? Doesn't that squeeze Instacart?
You'd think so, wouldn't you? But that's where the operational efficiency piece comes in. This is the impressive part. Management was clear. Unit economics are positive and improving across all basket sizes.
Oh.
Better logistics, things like improved routing algorithms, much better batching of orders, and just general shopper efficiencies.
Okay, batching. Explain that for us,
Oh.
like grouping orders.
Exactly. Think of it like pooling rides, but for groceries.
Yeah.
One shopper picks up multiple orders from the same store or nearby stores in one trip. It drastically cuts the cost for Instacart to fulfill each individual order.
And they mentioned batching priority orders.
Yeah, they said they're now batching about a quarter of their priority orders. Those are the faster delivery ones.
Yeah.
Being able to batch those efficiently shows they've really optimized their scheduling and density. That's how they can handle the lower AOV without killing their margins.
Okay, efficiency is key. Let's move to pillar number 2. Enterprise solutions. Rogers called this underappreciated. So this is Instacart selling its tech.
That's exactly it. It's not just the consumer marketplace.
Yeah.
They're licensing out the engine. Their storefront tech, the software for the websites and apps, powers the e-commerce for over 350 grocers now.
Like who?
Names like Cub Grocery and Liquor, Restaurant Depot. They're giving these grocers, especially mid-sized ones, the tools they need to compete online without having to build it all themselves.
And AI is the latest addition here.
Right. It's the intelligence layer. They've launched specific AI solutions. Things like Cart Assistant, that's like a generative AI shopping helper, and Catalog Engine, which uses AI to manage huge, complex product lists for grocers.
Who are they working with on that?
Big names. They mentioned partnerships with Kroger and Sprouts Farmers Market, leveraging all that shopping data they have. 1.5 billion lifetime orders. That's a lot of data to train AI on.
Speaking of Kroger, Instacart recently expanded that partnership. Kroger called them their primary delivery partner, even though Kroger works with others too. Is losing exclusivity a risk?
It's a fair question, but Instacart frames it differently. They see it as proof of how deeply embedded they are. They pointed out that over 80% of their GTV already comes from non-exclusive partners.
Oh, 80% already. Okay.
Yeah, and because their enterprise solutions, storefront, ads, data are so integrated into the retailer's operations, they maintain strong growth even without exclusivity. They're sticky.
And is this enterprise strategy their path for going international?
That seems to be the plan. They bought WinShop, which had an international footprint. So they're using that base and their tech toolkit storefront, Caper Smart Carts, FoodStorm for catering to look at markets like Europe and Australia. The idea is that grocers everywhere need this kind of tech enablement.
Okay, third pillar, the ads ecosystem. This has become a huge part of the business, right?
Oh, massive. Their platform serves over 7,500 brand partners now. It's easily one of the top retail media networks in North America.
And it works. Do brands see results?
Apparently so. They cited a figure. Brands see about a 25% sales lift on average when they advertise on Instacart. That's a pretty compelling ROI.
How are they growing ads beyond just the main Instacart app or website?
A couple of ways. One is Carrot Ads. That lets brands advertise on the websites of all those grocers using Instacart's storefront tech, so extending reach across hundreds of other sites.
Right.
And second, they're moving to the physical store with Caper ads on their smart carts and displays. They launched that with Wakefern, and it's rolling out to nearly 20% of Wakefern's co-op stores soon.
Ads on the smart cart you're pushing down the aisle. That's getting close to the purchase point, and they're partnering off-platform too.
For sure. The big one they highlighted was TikTok. Instacart is their first end-to-end retail media network partner.
What does that mean, end-to-end?
It means brands can use Instacart's purchase data to target ads on TikTok and then make those TikTok video ads directly shoppable through Instacart, closing the loop from ad view to purchase. They also mention deepening ties with Uber Eats, basically using their grocery data wherever people are browsing or shopping.
Okay, let's talk confidence and capital. Instacart's generating cash. What are they doing with it? Signals confidence.
A very strong signal, I'd say. They just authorized another $1.5 billion for share buybacks. That brings the total authorization up to $1.65 billion.
$1.65 billion. That's significant.
It is. And they're planning a $250 million accelerated share repurchase, an ASR. It's the biggest boost to their buyback plan yet. Tells you management thinks the stock is undervalued and they're confident in future cash flow.
But what about competition? Amazon, DoorDash, they're making big pushes into grocery too. How does Instacart hold its ground?
They focus on their core strength, the big
Yeah.
weekly shop. Instacart says they're still the clear leader among digital-first players, like 3x the share of the next biggest competitor. Why? Because they dominate the large baskets, orders over $75.
And that's most of the market.
They say it's about 75% of the online grocery market. So while others might compete on, a quick convenience order, Instacart owns that big, recurring, weekly stock up. That's their moat.
Okay, before we wrap, we should touch on that New York City regulation. The minimum wage changes for delivery workers. That's coming, right?
Yes, expected in early 2026. It's definitely a headwind. Management acknowledged it's not ideal. It'll likely mean higher fees for consumers in NYC, maybe fewer earning opportunities for shoppers there.
But how big an impact overall?
They stress that NYC is actually a pretty small slice of their total GTV. They seem confident that their nationwide scale and efficiency improvements mean they can manage the financial impact at the company level without derailing their overall profit goals.
Right. So wrapping it up, strong quarter, decent guidance, and a clear strategy playing out. Using that marketplace scale to become this essential tech partner for grocers everywhere.
That really sums it up. And maybe here's the final thought for you to consider. That stat about price parity retailers growing 10 points faster. It suggests the game is changing. It's not just about convenience anymore. It's about whether grocers will trade margin for volume and loyalty. So, if Instacart keeps pushing this model and more retailers shift away from exclusivity towards this price parity, tech-enabled partnership, does Instacart basically become a tech company that just happens to have started in delivery? Does that enablement identity completely overshadow the marketplace origin? It feels like the big growth story now might be selling the tools, not just digging for the gold yourself.